I am Russell Oshman. I'm a partner in the real estate group in Dallas. I'm happy to introduce the additional panelists and presenters we have today. I'll start to my right here with Brad Foxman, a partner in the restructuring and reorganization group in Dallas. And then joining us via Zoom or joining us in the conference room in New York, we have Christy Mazzola, who's a partner in our real estate group, Chris Mangian, who's a partner in the tax group, who is actually out of the DC office, but has flown into New York for this presentation. And then Jonathan Schwartz, who is our special guest today, Senior Managing Director from Walker & Dunlop in New York. I thank all of our panelists and thank you for joining us. And with that, let's go to the next slide and start the presentation. So today we're talking about distressed real estate loans and how to approach a workout discussion with your lender. This is a topic that's in the news a lot right now. It has been for the better part of this year, going into late last year. There's a lot of differing pressures on the real estate finance market. The latest numbers I saw were earlier today, actually, a report showing that something or just over 7.5% of CMBS loans are currently in distress. And that's defined to mean either there's been a payment default, a delinquency, or they have otherwise been put into special servicing for many different possible reasons, breach of covenants, things we'll talk about as we go through. Those numbers are kind of brought down by or really lowered by some of the stronger performing sectors of the commercial real estate market. Really, office and retail are sort of leading the pull up. Office is slightly over 10% is in distress. And this is, again, CMBS debt, so not including some of the on-book loans that we do. And retail has just ticked under 10% as of October. The slightly encouraging sign is that both office and retail are down from where they were in September. Or when I say down, actually lower than they were in September. But overall, the amount of CMBS loans in distress has ticked up now for the 10th consecutive month. So the overall condition is sort of spreading. The numbers are still relatively low in areas like self-storage and industrial, but those went up in the last month versus the others that went down. So this is going to continue to be a topic we see. When we get to the end, I think maybe we'll give a little bit of our general thoughts on where things are headed. But to get through the presentation, I mean, the first question kind of we had as a panel when looking at this was, if there's all this distress in the market, why aren't we seeing more foreclosures? And there have been some very high profile foreclosures, but largely there hasn't been this tidal wave of foreclosed assets coming to the market, or the deed in lieu scenario of someone handing the keys over to their lender. And there's sort of this underlying fact, and we saw this in 2008, 2009, and we're seeing it again, that really lenders would prefer not to have to foreclose on an asset. A lender makes a loan with the idea that that loan is going to perform. They're going to collect their interest over time, and then they're going to get paid back on the loan at the end. I think for a lot of lenders, it's actually a better scenario to delay when that end occurs if they think that there can be some conditions that can allow them to get repaid versus taking the property. Now that can change depending on the nature of the lender. Mostly I'm referring to banks and life insurance companies, some of the more traditional lenders who really are looking to collect interest. When you get into the more opportunistic debt funds out there, there are some who are kind of champing at the bit right now, waiting for these opportunities to go in and buy debt on the cheap, foreclose, and, you know, the sort of loan to own scenario. That's out there. There's a lot anecdotally evidence that funds are being raised right now for these distressed lending funds. And it's something that we may see a lot more of as this kind of soft real estate market continues. When you look at from the standard lender perspective, you know, there's part A is really, lenders are not really set up to own real estate. They do have groups who can do that. They are aware that that is a scenario that can occur, but it's really not what they're in the business of doing. And, you know, for the most part, they prefer not to do it. There's also, you know, what is their exit if they do take over and operate? Are there opportunities then to go out and sell? Can they sell for more than their debt? You know, can they get their money back? What are they going to do to improve the performance of a property that their borrower can't do? Especially if you know, good underwriting has been done up front on the quality of the operator, of the borrower, is a lender going to be in a better position to improve the quality of the asset? And then, you know, sort of what happens from the lender's perspective if they take a property back and nobody wants it? You know, they are then stuck with that asset. Yes, they have it at a lower basis than the property owner did, and may be willing to consider a lower price than the property owner would. But most borrowers are going to have looked at exit options when they know a default is coming. Now, some of these more technical defaults, maybe they don't know that the default is coming as early, but the big ticket, like failure, inability to pay it, repay the loan at maturity, you can see it coming. And most of the more sophisticated borrowers will have looked at the ability to bring in new equity, pay down the loan, pay off the loan, whether or not they can sell the asset. If a real estate investor or operator can't do that, who's to say that a bank can? We aren't seeing it because it's just not the preferred outcome. There has been some encouragement. There was a joint statement put out this summer by federal banking regulators encouraging banks to work with borrowers and give more time. Now, that doesn't necessarily have the power of law, but it does kind of tell you where the federal government is, you know, how it's positioning itself, and it does regulate these banks. We have, you know, markets out there that where the loans are totally underwater. If you 5 years ago were able to get a loan at 75% on an office building in downtown San Francisco, that might only be worth 50% of that valuation now. And therefore there's a 25% delta in the loan amount. But I mean, does the bank believe, do economists believe that we're at sort of the low ebb in what these prices are going to do, or is it going to continue to go down? Well, that all depends. And, you know, there's some people who take a much more optimistic view and some who are much more bearish on things. But to the overall question, why haven't we seen more foreclosures? It's a little bit too early, I think, is my opinion. Right now, everyone's kind of taking you can call it amend and extend, you can call it delay and pray, but the just wait and see what happens with the market. 6 months, 12 months, 18 months, 24 months, you know, when are things going to sort of right themselves? And when are we going to end up in a market where asset values start going back up and maybe you can exit these without having to take the keys? So let's move to the next slide, please. When is a property in distress? There's a lot of different scenarios. The most obvious one is delinquency or default in payment. And that can be at maturity, but there are also, you know, there's monthly payments due, depending on the nature of the loan. It could be interest only, could be interest and principal. There's other payments that can come due, various fees for reviewing or for kind of managing the loan. Failing to pay a payment when it's due is, under just about every loan document I've ever seen, a default. And some of these are easier to fix than others, but when a delinquent payment occurs or significant number of delinquent payments occur, then a property tips from performing to distress. And that's the most likely scenario, the most obvious. Breach of covenants is often a little bit more subtle. You know, all these loans have various financial covenants in them for what the property or the borrower or the guarantor has to achieve in terms of, you know, net cash flow versus debt service payments, their debt yield. They may have occupancy thresholds, prohibitions on taking certain actions with respect to tenants, even though those tenants may be in default. These covenants get breached. That is what I would call a lowercase d technical default. There's often some ability to cure that, but when you get into a down market, it can be sort of a self-fulfilling spiral downward. And that will tilt a property into distress. When occupancy starts to decrease, you're then going to end up not hitting your debt service coverage ratios. And you start defaulting under several different covenants. And there just is a natural belief or you know, kind of reaction to maybe one technical default, not the end of the world. 3, 4, it starts to really look like you need to bring some special servicing in to try to figure out a way out. There's maturity defaults related to payment defaults, but maturity defaults are inability to repay the loan, you know, at maturity. And that's really, I think that's something that we are going to see a little bit more of, maybe a lot more of. When you look at the numbers and the amount, the dollar amount of loans that are maturing in 2024, 2025, it could get really pretty ugly. You know, there's, I don't know if it's hundreds of billions or trillions of dollars of commercial real estate loans out there. And as the market has softened, there's not as easy of a way to exit those loans by selling at a number that is both sufficiently above the loan amount and enough above to get some kind of return back to your investors. So, you know, that's maturity default is one that is probably coming even more. And then the last one, which is kind of what we've just been through, at least in part, is sort of the unforeseen circumstance or force majeure. Pandemic being the most obvious one we all just lived through. The impacts of that were still kind of determining, feeling, you know, who's coming back to the office, how much office space is going to be needed. Retail too was significantly impacted. There were actually some positive impacts in sectors like industrial and multifamily. Those are starting to soften a bit as people do go back more to brick and mortar retail or are going back to their office more and maybe not then looking to spend as much on their housing. Sort of pandemic and then coming out of pandemic are really throwing things into flux. You know, the biggest factor probably right now has been interest rates, and we'll talk more about that as we go. But simply the cost of borrowing has increased. That has impacted, you know, rents that were put into place several years ago when interest rates were lower, prices that were, you know, purchase prices from several years ago when interest rates were lower. All of those numbers have not yet caught up to the interest rate increases, which have been occurring now for something like 18 months. You know, I think there's some optimism that maybe we will stabilize on interest rates, maybe even go down a little bit as we head into a presidential election year next year. But it's had a huge impact on commercial real estate loans. The question then is, you know, when do you loop in the lender? How do you loop in the lender? Do you loop in the lender when you see a default coming, or do you wait until the default has occurred? Some of that will depend on whether or not you do see it coming. And, you know, the how do you loop in the lender, just a sort of a note of caution that if you go read your non-recourse carve outs, that the, you know, admitting and writing your inability to pay debts can often trigger recourse to your guarantor. So exercise caution when discussing with your lender that maybe you're not going to be able to make a payment. Oftentimes those will be more in a general sense that you won't generally be able to pay your debts, not a specific debt. But for, you know, clients out there or for the lawyers in the room or on Zoom, you know, make sure somebody's checking the loan documents before you talk to the lender. That kind of takes us to the next slide of what to think about before approaching a lender. I may have stepped on some of Christy's points there, but Christy Mazzola is going to take over for the next few slides.
We could actually go back to your slide, Russell, for 1 second. I think here we've been seeing types of distress in all of these categories. We most recently have been seeing maturity defaults, and so dealing with how to work those out with lenders. But Jonathan, from your perspective, what have you been seeing in the market in terms of what distress is most common?
Yeah, I mean, look, I think it's a bit broad. I think there's plenty of maturity defaults. I would say there's plenty more breach of covenants, right? So insufficient cash flow to certainly service debt, the reduced occupancy that I see you guys have on the slides. I mean, look, it's all a function of, you know, what asset class, right? I mean, it's hard to paint a broad brush. All of these exist in real time, but you know, look, if you just look at office assets, right? I mean, there are plenty of office assets, unlike this building, that's a Class A building that's likely going to retain its occupancy at 90+%. In an amazing market, great location. Like this asset's not going to be an issue, I would say, for most lenders, unless, you know, they just simply can't refi because they put on too much debt and the interest rate goes from 3 to 6+%. That's a different story, right? They have to put in more money maybe, but the fundamentals of this particular asset are fine. It's the kind of Class B generic office assets, suburban markets, even in New York, that across the board have had major issues. So yeah, I mean, look, we've seen, you know, physical issues on the office side. I think retail has recovered a bit. There was a big market reset, I think, many years ago in the retail sector, with, you know, high street rents were well north of $2,000 a foot. Those days are over, certainly in major metros, and now today it's less. Debt's kind of reset. COVID's past us, and look, as far as industrial multifamily go, the biggest issues there are really capital markets driven. It's not the fundamentals of those assets. In the multifamily space, you know, what we've seen is that cap rates have gone from, in the best markets, 3.5 to now close to 6. You know, people borrowed 80%, 75% of cost at 250 over SOFR when SOFR was 0. SOFR is 5.5%. Insurance is up 400% on deals. Other operating expenses are up, but rents are also up. But rents are not up enough to battle, you know, insurance going up that much, not to mention interest rates spiking. So, you know, those are really more covenant issues. That's not a fundamental issue with an asset class. So I guess to answer your question, look, it's across the board. I think the maturity default is probably the least of people's issues. It's mostly covenants at this point that people just can't meet.
If we can go to the next slide. So as Russell mentioned, we of course look at our loan documents. We look at what triggers an event of default. We look at your guarantees for what triggers recourse. I think we did a presentation that focused more on what's in our loan documents and what we do with that a few months ago, if anybody had joined that. And in terms of the cause and severity, we'll look at if this is property specific, if it's something that, you know, it is a multifamily building, but there's just some issue with your property, but generally multifamily is doing okay and the market you're in is okay. Or if this is a more high level market force issue where you have a Class B office building in New York and the lender probably has some other assets dealing with the same problems. In addition to those, what we'll say are the gating issues here, there are some additional considerations that we would talk about, and also talk to someone like Jonathan or a broker to get their views on. If we could go to the next slide. So cost and risk of litigation and foreclosure for both parties. For borrowers, obviously, sometimes you want to be able to work this out with the lender. Sometimes you might want to hand the keys back. There are practical gating issues for the lender in particular to foreclosure. Brad, do you want to take us through some issues there?
Yeah, I would, and thank you, Christy. And so any decision about whether to approach a lender and how and when has to be done with thought about what that lender might do if the lender wants to exercise its rights and remedies under the loan documents, right? And so in terms of thinking about what those options are with respect to real property and real estate and the collateral, the lender will look at the time and the process in order to realize on that collateral. And so This is a very state-specific process. Some states have non-judicial foreclosure where it can be done fairly quickly. Other states have a judicial process where in order to actually foreclose upon a piece of real estate, you have to commence a lawsuit. That process in almost every state for real estate takes some time. And while the bank waits for that notice period to run, the borrower can do contingency planning. There's issues with respect to how the property is managed and preventing deterioration of the collateral and deterioration of the property. And the lender will think through that and their own internal risk preferences before they make any decision about how aggressively to pursue that collateral. In some regards, some states' process is very straightforward, and in other states, it's quite difficult. So for example, in Texas, there's a deadline to post property for foreclosure at the courthouse, and there's a sale on the first Tuesday of every month on the courthouse steps where real estate is sold in a foreclosure. And each state has a totally different process in that regard. In Texas, there's no judicial foreclosure required, and that can go forward, but it's typically not a thorough marketing process to post a property for foreclosure. So there could be a value loss to a lender by selling something at a foreclosure sale where the only people who are participating in that process are people who are monitoring, foreclosure type notices versus a normal broker-led, broker-run sale process where an asset is sold, as an operating building, as a going concern, and that kind of thing. And so in that regard, when a lender posts a property for foreclosure, because of that risk that buyers might not show up, the lender has to think about whether or not they might want a credit bid at that foreclosure sale and potentially acquire that real property collateral by using its debt as a currency at that foreclosure auction. If a lender acquires the real estate and makes it REO, real estate owned, at that point, it has to tend it, it has to keep up with it. It's then got to run a sale process. And as Russell mentioned in the lead-in, lenders might not be well set up for that. Some are set up better for that than others, or have specialties in certain subsets of real estate, versus others. So that is a very significant consideration from a lender perspective. And some lenders will prefer, rather than going down that foreclosure process, to actually commence a lawsuit and seek to get a receiver appointed over the property, have that receiver manage the rents, manage the asset, tend to the situation as a whole, and have a very controlled sale process with brokers and professionals under the oversight of the state court. But one thing that every lender has to keep in mind is that a borrower could file a bankruptcy process. Once a bankruptcy is filed, the bankruptcy has an injunction within the proceeding called the automatic stay, and that injunction stops any foreclosure or exercise of remedies and brings in front of the bankruptcy court a process to either sell the assets or maximize the value or have a restructuring. And that is the primary defensive tactic that a lender could use to try to stop those remedies. In that regard, there's been some changes to the bankruptcy code regarding single asset real estate debtors, special purpose entities that just own one piece of property. And that's made that a little bit less common of a strategy in that context. But where you have an entity that owns multiple pieces of real estate, it can go into a more traditional restructuring process. And there's a federal court overlay in terms of what everyone's rights and remedies are in connection with that process. And coming back to our presentation, when do you approach a lender? How do you approach a lender? That legal rubric that overlays what the lender might do and what the borrower could do to protect itself informs the strategy. And so generally, if you can go to your lender with a very constructive plan showing how they're going to get a better business outcome than what they might get with the professional fees and the cost and the risk of exercising remedies and going into a bankruptcy process, that has potential for a much better out-of-court negotiation with a lender than if you go to the lender and just say, hey, give me some more time. I want to preserve my equity. I think the property's a lot more. Let's just kind of wait and see. If you can come with a constructive plan to improve the asset and improve the actual economics to the lender's recovery, there's a better dynamic there. And different lenders will have different risk tolerances and philosophies as to how much of that they'll entertain versus going faster to remedies.
I think in terms of costs and risks of foreclosure for the lender, for the borrower, the tool there is, depending on where you are, it could be a timing benefit that it could take the lender a while. It could be a cost analysis where the lender might be, like you said, marketing to a smaller audience. But another consideration, I think, from the borrower's perspective, we, for a long period of time, did a lot of mortgage financings where the lender wanted an accommodation pledge. So a pledge of the equity interest in the borrower. And the only reason for that was to help them foreclose more quickly in a place like New York, where there is judicial foreclosure. And so they could foreclose on their equity pledge, even though they were not providing any mezz financing. So in that situation, a consideration where the timing might not be as beneficial for you if there is an accommodation pledge to your senior lender. And then Brad, to your point about offering the lender something, current value and performance of the property and prospects for improving the property. Like you said, the lender is going to want something in return. If you go to them and you're asking for more term, deferred interest, which we'll get to the request to the lender, but they're going to want something in return. So before you go to them, considering what you might be able to offer, a lot of this depends on how the property is doing and occupancy and the goals of the borrower. Does the borrower want to stay in this deal, or are they not looking to inject any more equity? Jonathan, I know we've talked about this a lot in some of the deals we're working on together, but what have you seen with borrowers? Are they willing to put more cash in to keep their properties afloat?
Great question. It's purely situational. I would say most borrowers prefer obviously not to have to put in fresh capital. I think lenders right now are looking, if anything, for, again, depending on the situation, are looking certainly to have an interest reserve topped off so they know they're being paid current. Other lenders are looking for actual pay downs. It's all a function of what the value is. So, I'll give you a real-time example of something we recently did. We helped RXR restructure debt on 450 Lexington Avenue. It's an office building next to Grand Central on a leasehold. The anchor tenant in that building had a good story. They were actually renewing for 25 years, another law firm. The NOI was going from $40 million to $45 million. They were spending $200 million in TILCs and all the work that needed to actually take the NOI of $5 million. So not a great return on equity, but they needed more term on their existing debt. They obviously had an anchor tenant, and there was a bridge in terms of when the cash flow would kick in. So, we went to the insurance company who had the senior loan. They had amortization on their deal. They had a low interest rate. We said, look, give us 2 more years of term. Get rid of your amortization of 30 years. Give us an interest-only loan and allow us to bring in subordinate mezz financing to bridge that cash flow gap. We haggled back and forth, but ultimately that lender, given the story there, allowed us, to extend, and they gave us all that. They also took an equity pledge or an equity funding guarantee versus RXR and their partners having to put the money in up front. So that was a very good outcome, but obviously had a compelling story. We've been a part of recent deals where, clients have just said, look, I have no more money to put in. The value's deteriorated below where the debt is. And then the dance kind of begins. And again, I think it goes back to the beginning of this conversation. I would tell you 99% of these lenders want nothing to do with these assets. They don't want to own them. They don't want to operate them. Certainly on the commercial bank side, life insurance company side. I think when you're talking about private equity firms that have mortgage REITs, credit funds, they're a bit more inclined to step into ownership as they have teams that play in the ownership side of the business. And they feel a lot more comfortable, but I think the kicking the can down the road is going to stop shortly, but no one is being forced to really do anything yet. And until there's until there's a reality check, frankly, from most of these lenders where they're marking their positions properly on their books. And the only person that can do that is, really obviously these funds and the government telling them to do it. Nobody's gonna do it. So, there's no reason that, Blackstone or Brookfield are marking positions at a 4.5 cap on an office asset when, the 10-year treasury is at, 4.5%. That obviously doesn't make economic sense, right? So until people start marking things properly, I don't think you're going to see much movement. But there's obviously people writing checks into deals, and there's situations where people are just giving these back, saying, move on.
We have a situation now where we're dealing with some senior lenders, and we're trying to bring in mezz debt, even though it's not technically allowed by the senior loan documents. Have you seen senior lenders be flexible in that situation to try to accommodate mezz or pref, whatever you want to call it?
Yeah, I think obviously the RXR deal, 450 Lex is a perfect example of that. But yes, I think if money is coming in, fresh capital is coming in, that's going to go towards improving what they view as the value in the collateral. Then, I think most lenders today are open to that conversation, depending on certainly who that group is. But yes.
We have been trying to get around an issue where senior lenders is not open to bringing in quote unquote mezz, but would be open to bringing in pref. And so Chris and I have been talking about how to shape a document that would be treated as debt for tax purposes, but still helpful for our borrower and for the provider. And so there's some tax considerations there.
Yeah, that's a tricky issue because anytime you have a document that's you sort of choose your form as equity, it's then difficult to go back and argue that it's debt. But we've worked with some of the big four accounting firms on these issues, and with a lot of bells and whistles, both added and taken out of a typical preferred equity agreement, we can usually get to a place where we can accommodate that.
I think we'll be talking about that more later. If we could go to the next slide. Okay, so the most popular request we've seen from borrowers, by far the biggest request we have seen here has been an extended term. People just want time to figure out what to do, whether it's time to figure out how to refinance or to bring in some additional equity, or just work it out with the lender to make some modifications. So we've seen short-term extensions, 1 month, to just try to talk to the lender about something additional. We recently had a short-term 1 month extension where the borrower also signed a pre-negotiation agreement, and we tried to negotiate a longer extension because we were facing a maturity date default, and ended up at a place where we had an 18-month extension plus 2 6-month options. So that got our borrower pretty close to a period where they felt like they would be safer in trying to refi. I think we've heard the saying, survive till 25, to try to just push it out as far as possible here.
Let me ask you something. So in these situations, what did the borrower do to get the lender to provide this?
So in this situation, we had paid fees upfront to the lender. There was an extension option fee that they imposed on us. There was also just a consent fee, which they could have called anything, but was a decent amount of money. We put up a letter of credit, we reaffirmed guarantees, and we agreed to put certain amounts of TI money into the building to try to get to 70% leased, at which point some of these requirements would either go away or be reduced. But there was a whole lot given.
So
in
fresh
return.
capital was coming in.
Yes.
Right?
Yes.
Makes sense.
Interest deferral has also been something we've been seeing, where borrowers will pay either a portion of the interest that is payable monthly, or in some cases try to pay no interest for a short period of time, but mostly some portion of the interest due monthly, with a bigger amount deferred until maturity or closer to maturity. In the amendment I was just referring to, we ended up asking for a reduction in our spread once we hit certain leasing thresholds. This was new construction. The loan was the loan was originated about 4 years ago. And so we were trying to lease up an office building. We were close, but we had 2 major leases that were not yet signed. We were hoping to be signed to use as leverage for our negotiation with the lender. But so once we got those signed, there was a small reduction in our spread. And once we hit 70% leasing, there was another reduction in our spread. We also often get the request for renegotiating financial tests. Typically, in the initial drafts of our documents, we would try to have the right to prepay to meet any financial tests, which might be a condition to extension. If we don't have the right to prepay, that's an ask from the borrower that they have that right to get the lender more comfortable, or to just renegotiate the tests down from what they are to potentially meet a further extension test. What have you been seeing as popular borrower requests that have actually been entertained by lenders here?
Yeah, look, I think you nailed a bunch of them. I think people have given, certainly depending on the strength of the guarantor, the borrower, they've given, enhancements, personal guarantees in lieu of, potentially putting up new money. Yeah, but I think there's not too many levers to pull, right? I mean, it's either you're putting up fresh reserves, you're paying a fee, you're giving a credit enhancement, whether it's a letter of credit or some type of PG. Outside of that, or you're bringing in preferred equity or mezz, really probably preferred equity with someone that is again bringing in kind of fresh capital that sits in front of the borrower and that the lender's comfortable with. So I think you guys have nailed it here.
Brad, do you want to talk a bit about amendments and waivers versus forbearance?
Yeah, absolutely. And so once a borrower and lender come to an agreement on business terms regarding these requests, or if they come to an agreement on these requests, there's really 2 ways that this can get documented. One is through an amendment or a waiver where the past defaults are waived and the credit agreement itself is modified to reflect the new business deal going forward. There's various bells and whistles that could be attached to that, but the substance is that the defaults are essentially waived and gone. That's different from a forbearance agreement, which is another way that lenders and borrowers can document a deal going forward. And in a forbearance agreement, the defaults that existed previously remain alive. And not only do they remain alive, the borrower agrees that those defaults are valid and enforceable and have occurred. In exchange, what the borrower gets from the lender is an agreement for the lender not to exercise remedies against the collateral or otherwise, to remain in a standstill in connection with the loan. There are some benefits to a lender for being in a forbearance over a waiver, because in the forbearance, if there's another default, all the old defaults come back alive and become items that the lender can enforce rights and remedies on. Oftentimes in both amendments or forbearances, you'll see some of the same kinds of lender type protections required. And there's more of that on the next slide, like releases, milestones for a sale process, hiring of professionals, a lot of times negotiation around default interest or that kind of thing. But there is that marginal benefit to the lender, because if a lender does have to exercise remedies and the underlying defaults have been stipulated to, that does impair the ability of the borrower to then contest in court that those have occurred. And especially when you have defaults that are more financial covenant type defaults rather than payment defaults, limiting the ability of the borrower to argue about the occurrence of those financial covenants does have a benefit in subsequent litigation. And that's why some banks are focused on wanting that forbearance agreement over an amendment.
Thanks, Brad. I think that's a good transition to the next slide. So we talked about some of this. What is the lender going to ask for in return when you go to them? The first thing we have been seeing is they want fees. They just want some cash up front. So again, whether they call it an extension fee or a consent fee or whatever other term they want to use for it, there's generally some fee for them agreeing to this amendment. We've also been seeing prepayment penalties in terms of if you do get some extension, let's say it's a 12-month extension, they will not, they don't want you to prepay before the 12 months has run because they want all of their interest during that time. So if you prepay before that, there is some minimum payment due to the lender. And default interest, if there had been a default, they still might be trying to collect that default interest when you do agree to some deal with them. In terms of equity injections, Jonathan, I think you addressed this and has come up a few times, but the lender, for the most part, is going to ask for some fresh capital to be put into their project. I think a solution that you mentioned and that maybe we'll be seeing some more of is negotiating when the borrower can get that capital back so that it is not all just in their mind sunk into the building. Have you been seeing that a lot?
Yeah, I think it's been more on the office side to induce certain borrowers to put in fresh capital. They're saying if we're going to do that, then we want our money to actually come back to us first as the building starts to cash flow. I actually couldn't believe that a lender would do that, but I think when you get down to desperation at some point, you don't think that someone's going to put money into a B office building, and you know you're going to lose your shirt. They're stretching to allow people to do things. So we've started to see that, which I think is really interesting. I don't think that's going to be in every single case, but if you have the right, I guess, situation, there are some certain borrowers that are going to get their money out before a lender gets their money back, which is pretty interesting.
Yeah, definitely. We've also been seeing, again, just in terms of making the lender feel comfortable, requests for additional reserves or guarantees or letters of credit. They want to know their interest is going to be paid during the extension term. And if we are agreeing to put some money into the deal on a go-forward basis, they might ask for that to be put into a reserve upfront. They might ask for a guarantee of interest during the extension term. We've even seen lenders ask for full repayment guarantees, which, as everyone knows, is highly unlikely for the deals we do, but it has been a lender request. And in certain situations, we've had property owners willing to do that to get the time they need. Letters of credit, we talked a bit about how we might post a letter of credit when we sign the amendment. The amount might burn down and become available to the borrower to use for TILC, or just might be released to the borrower once we hit certain thresholds, whether it's leasing thresholds or certain time periods. And then Brad, releases and stipulations.
Yeah, those are both very important and oftentimes things that you'll see. So stipulations, that's the agreement as to the defaults like we talked about before in connection with the forbearance so that you don't litigate that. There's also a concern amongst lenders about potential lender liability risks. And so in many cases, the forbearance or amendment will contain a release of claims and causes of action against the lender by the borrower. Now, those are not infallible if there's a subsequent bankruptcy, but it does help in many ways deal with those issues and is a marginally incremental improvement to a lender. I think I touched before on milestones for sale or restructuring, but oftentimes if a lender is going to give more time and give business concessions to a borrower, it wants to make sure that the borrower is taking steps to monetize them or to enable their recovery rather than just delaying the problem. So it's very, very common to see specific dates and deadlines where a borrower has to take certain actions like retaining a broker, undertaking a marketing effort, improvements in operations, trying to refi or those kind of things. And if they don't meet those milestones, then the forbearance might terminate and the lender can go back to exercising remedies. And so those lender requests have a lot of value. And circling back to something that Christy touched on, the additional one is the credit support, the guarantees and the letters of credit and the reserves. In thinking about each of those, they're not the same if a borrower files bankruptcy. If a borrower has a reserve of cash on its balance sheet, that might be cash collateral in the bankruptcy process where the automatic stay could prevent the lender from accessing it. In contrast, if the borrower posts a letter of credit, that creates a third-party relationship between the issuing bank of the letter of credit and the beneficiary bank who's lent on the property. That third-party relationship is not subject to the automatic stay, and that credit support can be drawn and applied. in contrast to the posting of cash collateral. The guarantees are also additional credit support, to the extent that the guarantor is solvent and doesn't file bankruptcy. But at some point, the guarantor might also file bankruptcy, and that might not be as much credit support as when you have a bank issuing a letter of credit and that bank's subject to regulatory capital requirements.
So I think we've talked about what the lender concerns would be, what borrowers would ask for, but all of this does have potential tax consequences. So I'll turn it over to Chris to talk about some of those.
Yeah, let's hit the next slide. You might be asking yourself why there's a tax lawyer on this panel. In fact, on the way in, Wally Schwartz asked me what the hell I was doing here today. But yeah, I know. We'll try to answer that question briefly. We could do 2 hours just on this slide. So, you're negotiating a workout, an amendment of some type with your lender. What does tax have to do with it? Well, the issue that comes up is when you make certain kinds of changes to a debt instrument, there can, for tax purposes, be a deemed exchange of the existing debt instrument for what is termed to be a new debt instrument. And the headline there is that under certain circumstances, that can result in cancellation of indebtedness income for the borrower and gain to the lender. And what's really bad about both of those outcomes is those are types of taxable income that are phantom income, meaning that they come with no cash attached to them, which makes for an unhappy day for everyone involved. So I'm going to hit just some of the high points of some of the changes that you could make to a debt instrument to have it result in a deemed exchange based on some of the things that we've talked about here today. I'm going to start with a forbearance. So a forbearance is not considered to be a quote unquote significant modification of a loan unless it exceeds 2 years. So that's something to keep in mind. In the amend and extend portion of the discussion, if you defer payments or extend the maturity date, that might result in a significant modification. But there's a safe harbor in the Treasury regulations that says if the delay in payment says that the delay in payment is not material if the deferral doesn't extend beyond the lesser of 5 years or 50% of the original term of the instrument. And then the third thing I wanted to touch on that we've discussed here is that there's a specific rule that the addition, deletion, or alteration of customary financial covenants is not a significant modification. So if you're negotiating changes to your financial covenants with your lender, typically that's not going to result in one of these deemed debt for debt exchanges and with all the negative consequences of that. So if you take one thing away from this conversation, it's that you should involve a tax advisor when you're negotiating these items with the lender to avoid a nasty surprise. I think we can go to the next slide.
So we have a couple of case studies here to talk about. The first one here is something we're working on with Jonathan actually, but it's a distressed office property. It happens to be in DC. It would be a membership interest acquisition where we would be buying the interest in the guarantor, which is an upper tier entity that owns the borrower. It's an interesting situation because the debt currently on the properties has very low interest rates, but does have maturity in 2024. So the question in this situation is, the things we have talked about is this buyer willing to put money into this asset? And do we go to the lender to only ask for consent for the change of control, or do we also at the same time try to negotiate an extension rather than taking a gamble and seeing where we are next year and if we're in a better or worse situation? So I know your team has been running numbers and trying to figure out where we can have some leverage here with some of these lenders and this is still in early stages, so still a process that we're all going through.
Yeah, I mean, look, look, and this is 4 assets, all office properties in Washington, DC. One asset has long-term fixed rate CMBS financing on it, which is less of an immediate concern. And then there are 3 assets that have, 2 have bank debt and one has or maybe 1 is bank debt and 2 has life insurance company debt. So those are portfolio lenders. They know the maturities are coming. They now have I guess, a new borrower that they have to talk to that is not local to the immediate market of the country. So, look, part of our analysis is going to be, what are these assets worth today, right? What does the leasing market and office market look like in Washington, DC? How much capital is it going to take to re-tenant these buildings as leases roll? So there's a lot of different factors that are involved in effectively going back to these lenders and figuring out whether, this client is actually going to even put in any fresh equity. They may be in a position where they just say there's not much to do here and we're going to give the keys back. Or alternatively, they think there's something to do and we bring in and help, introduce them to an operating partner that, believes in office in this location and area. Or, maybe there's an alternative use for these assets, right? We've heard a lot about, office to residential conversions and other asset classes. I think this is a really interesting case study that's going to obviously play out, but there's some lenders here that are obviously going to have some interesting conversations coming their way. But look, I think we're gonna figure out a solution one way or the other.
And so one issue that has been coming up is fraudulent conveyance issues. If we are buying membership interest and there's cash at, let's say, the guarantor level, because that guarantor needs to meet net worth and liquidity requirements, what happens if any portion of that cash is pulled out? Is that an issue for only the guarantor entity? Does it become an issue for the parents, which are typically insulated absent some extreme circumstances? Brad, any thoughts on fraudulent conveyance and whether we've been seeing any issues with that in any real estate deals?
Yeah, that's a huge issue, not only in real estate deals, but in all transactions generally, especially those with complex org structures where you have different parents and subsidiaries and brothers and sisters and cousin entities and guarantors. And so for those that aren't familiar with fraudulent transfer or fraudulent conveyance law generally, both state law and the bankruptcy code provide in certain circumstances that if a entity transfers its property without reasonably equivalent value in exchange and is either insolvent or meets certain other solvency cash flow type tests, that transfer can get clawed back. Either the property transferred or the value of the property transferred can come back. And that dynamic of the deal potentially being undone creates a risk to buyers in transactions where buyers look and they'll look at the org structure and try to compare each transfer as part of the transaction to see what that entity is getting in exchange for the transfer and whether there was reasonably equivalent value as part of that. And so here where you have cash moving from potentially different boxes within the org structure, whether in a parent or guarantor capacity or otherwise, there is a fraudulent transfer issue that has to be analyzed and a buyer has to be comfortable with. And there's generally, anytime a buyer buys an asset, a fraudulent transfer consideration, are they paying reasonably equivalent value and doing a transaction with a distressed seller, even if there's not the complexity of an org structure. If you're buying something that's widely traded and quoted, right, there's not a big risk of that because you're almost certainly paying inherent value for some, if you go buy a share of Microsoft stock, right, you're paying for the value of the stock. But with assets that are less liquid and that don't have that kind of trading marketplace, it's an inherent buyer risk, and one in complex transactions that we spend a lot of time working with our transactional colleagues, thinking about those risks and making sure that everyone understands how they might play out if there's an insolvency event for the counterparty.
And then one last interesting topic on this one before we go to our last case study: tax issues in connection with this structure. A foreign buyer that doesn't have any assets here what does that look like for them?
Yeah, so just generally speaking, a foreign investor, a foreign buyer is not going to want to come directly into the United States. They're going to want to do so through a blocker. And the chief benefit of that is that prevents them from having to file tax returns in the US. And so in this case in particular, I believe the guarantor entity was already set up as a C Corp blocker by the prior owner. And then what you'll often see in these structures is a second level blocker as well that's set up in a foreign jurisdiction such as Cayman Islands, Luxembourg, but it doesn't have to be either of those. And what you do there, we refer to those as hybrid blockers, and those serve a couple of purposes. Number one, let me go back for a second. With a hybrid blocker, it's set up to be a flow-through entity under local law, so in Luxembourg, for example, but it's checked closed as a corporation for US tax purposes. And so from the US perspective, it's a corporation. And that serves two important functions. Number one, if any effectively connected income escapes the lower tier blocker structure, the second level blocker prevents the ultimate foreign investors from having to file US tax returns. And then also just as important, if the ultimate investors are fund investors, inserting that second level blocker allows for transfers of interests up at the fund level. Without that second level blocker, those transfers of interests at the foreign fund level would be subject to FIRPTA tax in the US.
If we could go to the next slide, I know we only have a couple minutes left, but one particularly relevant topic, so I'll kick it back to Dallas.
Yeah, and so just in a minute or two or less, y'all might have seen that WeWork filed for bankruptcy on Tuesday with a small amount of $4.2 billion in debt. This was a fairly expected bankruptcy filing and a stressed business because of the office utilization. And so in the filing, they filed with the agreement of their first lien and second lien notes to equitize approximately $3 billion of debt coming out. Everybody south of that in the capital structure is going to get a donut for the most part under the plan that they've proposed. And so they've proposed a fairly aggressive timeline to try and come out of bankruptcy in March, but query whether that will be possible or not. And as to today, this is really the largest real estate bankruptcy going on right now, other than the Yellow Trucking bankruptcy that's also been going since the fall. But in that regard, there's approximately, I think, 700 leased locations, 400 landlords. They're already trying to reject 60 leases in the case to right-size the business and trying to negotiate lease amendments with many more landlords. They had the first day hearing yesterday in in New Jersey. And the key quote from debtors counsel was that, quote, "Our financial creditors made meaningful concessions and we expect our landlords to do the same." And so there will be a significant amount of real estate bankruptcy activity generated from that case. And everyone will be watching with quite a significant amount of press and financial risk there.
All right, let's keep jumping. Next slide. Anything else we need to talk about on WeWork or just run through these?
Yeah, we can skip through.
All
these.
right, go to the next slide and one more. Okay, so I know we're over. I will not bore everyone with my predictions on what the results here are going to be of the amend and extend strategy, but did want to kick this back to New York to Jonathan to see if he had any predictions or prognostications of what we're looking at in 2024.
My crystal ball.
Yeah.
Yeah, I mean, look, my opinion and our firm's opinion is that certainly rates are going to stay higher for longer. I don't think that that's, saying anything that's too controversial. Obviously, treasuries come down a little bit, but Yeah, look, I think we are gonna hit a point, and maybe it's Q1 next year, Q2, where I think we're gonna start to see a significant amount of note sales. I think a lot of these banks, more on the regional side, are just gonna have to blow out a lot of their deals. I think part of that issue is that, you know, the Fed has not really laid out what kind of reserves these lenders are gonna have to hold against their real estate loan exposure. What we've seen recently is, you know, HSBC, Capital One, these are very large commercial banks that have sold performing real estate loan portfolios. I don't think that the real estate folks in those situations actually wanted to sell those loans. I know some of them. It really came from the top of the house to say, look, at some point next year, the Fed's going to tell us, you know, what reserves we need to have. We don't even want to have the conversation. We have issues in other parts of the bank. Sell this right now for the most you can get, right? And, you know, they provided seller financing to those buyers, and away you go. I think there's going to be a lot of commercial banks that are going to have to reduce exposure on the commercial real estate front. They've lost deposits. And so you look, I don't think the amend and extend from the commercial banks is going to continue. I'm just not going to be able to, assuming rates stay higher. If rates get cut, then look, everything I'm saying is off the table, and, you know, people will refinance their loans, I guess, to an extent. But that's what I would tell you from a commercial bank perspective. I think the debt funds, mortgage REITs, private equity firms are in a little bit of a similar situation, although they're more inclined, I would say, to probably take back assets if they needed to, and kind of work through situations with certain lenders or certain borrowers. I mean, it really just depends who they're dealing with. I mean, you know, it's funny, the largest firms in the country world, you know, the Blackstones, the Brookfields, are usually the first to kind of throw the keys back when they feel there's literally no, you know, value left in a certain asset. I don't think it's gotten enough press. They've given the keys back on a lot, those firms, and they've borrowed from everybody, you know. So, you know, no one's immune to this. And look, we're frankly in uncharted territories. But my prediction is that, you know, next year I think is still going to be pretty ugly. But I think there will be more activity on the loan sale side versus restructuring deals. I don't think there's nothing to restructure anymore. And also today, I guess before I stop talking, you know, Signature Bank's portfolio is getting bid on today. Bids are due today. Those are, you know, I think there's 13 pools. I think those pools comprise roughly $30 billion of mostly real estate credit. Once those values have been set, right, I think that will start, you know, the wheels churning on other institutions saying, look, the value's been set on either these, you know, these pools, these assets, and now we kind of have a green light to move forward. I think a lot of people have been waiting, even the FDIC have been waiting to see the results of that sale, which I think we're going to find out certainly, if not today, tomorrow. So those are my 2 cents.
All right, well, thank you. And thanks to everybody for joining us. If you do have questions, we'll look through and see if any were submitted. But certainly, if you're in Dallas or New York, just stop by any of our offices and we're happy to discuss. Thanks for coming. Have a good afternoon.